Hi, this is David Dickens, and today we are going to do a 2025 year in review. What actually mattered for your money and your retirement plan with all the big headlines that went on? I'll go get Walter, and we'll get started.
It's another edition of Cover Your Assets KC. Walter Storholt with you once again for the final time in 2025, alongside, of course, David Dickens, President, Wealth Advisor, Creative One Advisors Group, serving you throughout the Kansas City area and beyond. You can find us online at creativeoneadvisorsgroup.com. Happy end of the year to you, David. One more in the tank, my friend.
Yeah, it's been a really, I guess, you hear this a lot, but it's been a really fast year.
Yep. We could probably go back and play the final episode that we've recorded for the last 5 years, and we say that each one, right? Like but it's true. Every year goes by faster.
It does. And so this topic that we've chosen for today, with these, we're going to cover 5 big events that happened in 2025. And those are the type of events that just seem to make it go faster and faster. So hopefully there's something in here that's meaningful for each one of our listeners, but it has been quite a year, and it has really flown by.
I'll tell you what, from a perspective standpoint, these types of episodes and this type of moment for us to be able to do this and look back is really helpful because it clarifies a few things. One, a lot happens in a year. That's my first takeaway before we even dive into these. There's a lot that goes on over the course of a year in the financial realm. And two, some of them feel really big when you're going through them. And once they're in that rearview mirror, you get the proper context, you get the fear taken out of the equation, and you're able to kind of talk about them a little bit more normally than maybe how scary or nerve-wracking it felt going through it. Maybe some things appear bigger than they were in real time once you look in the rearview mirror as well. So I'd be interested to see what people's different kind of reactions are when you hear all these things that have happened in the past year. Kind of go, man, yeah, that's a lot of moving parts to keep track of. So this should be fun.
For sure.
I would imagine at the top of anybody's list from a financial angle, looking back at the past year, you would identify the tariffs. If we want to, segment it to a specific day or month, around April, we had that Liberation Day where they all kind of, hit at one time, it felt like. That's got to be kind of the top headline of the year, I would think.
Yeah, it certainly was for me and for the markets. That caused almost an immediate 20% downturn in the S&P 500, over 3 or 4 weeks, because it created so much uncertainty. That was a real volatile moment, and it did cause a number of our clients to say, okay, let's get together and chat this through. So I think it was such a big thing at the time. So Trump has this long history of punching people in the nose to get their attention, and then the negotiations
it's a great way to put it. Yeah, exactly.
Then the negotiations start. He threw out some pretty crazy numbers on that chart of his that were way in excess of what anybody in the markets was thinking was going to happen. Everybody was kind of good with reciprocal tariffs, but that's not what we got. So I immediately, anytime that kind of thing happens, I think of the Mike Tyson quote, everybody has a plan until they get punched in the mouth. And
especially when Trump's doing the punching in the mouth.
Because he has so much power, and and he's so willing to use all of these resources he has to get out his message before it all gets, tamped down by the people around him. So that was massive, and the market did not take it lightly. But the rebound, I think the thing that makes it very Trumpian is that once everybody realized that's his starting point, that's not where we're going to be, then the market goes, oh, that's right. And so we had a really, really quick rebound off of that 19 or 20% downturn in the S&P. So luckily, we did not encourage our clients to do anything with that because it seemed like that was certainly not an economics-driven or U.S. economy-driven downturn. It was a news cycle-driven downturn. And so that ended up being exactly right. Don't make changes because it's about fear, uncertainty, and doubt. FUD is kind of the acronym that gets tossed around a lot these days. But the fear, uncertainty, and doubt around all of that just needed a little time to clear. So there it's really, really important. The hindsight or the takeaway from that for me, for my staff, and for our clients was it was important to understand that these tariffs didn't create any immediate change in the economic outlook for the companies and their profits, and that's truly what drives the intermediate term value of the stock market and the companies that make up the stock market. So in the middle of that, taking a step back, a nice deep breath, and figuring out, is this actually going to have a long-term impact? The answer is, we don't know, but probably not, because after Trump stepped right back in 3, 4, 5 weeks later and said, wait a minute, that's not where we're going, because I believe the people around him said, hey, Mr. President, you got to get out there and say, this is not truly where we're going. So that one passed, and we got pretty much right into our second major event of 2025.
Yeah, great point. And that was inflation persisting throughout the year. You know, we were kind of hoping things would slow down, reverse maybe the other direction a little bit. But man, talk about getting punched in the mouth. That's certainly where people are doing it to Trump, right? Looking at those grocery prices again and kind of feeling the inflation pinch ongoing for Americans all across the board.
Exactly. So there were some different reasons for that, one of which certainly was the tariffs. So just to kind of tie those first two together, we tariffed everybody. The Canadians, the EU.
Literally everybody.
Literally everybody.
Neighbors,
China,
family members.
all that stuff that went from China to India and to Vietnam, we tariffed the heck out of those people too. And so tariffs are really just a tax. And they get, so it's not, tariff isn't really an inflation because it's a one-time pop. That doesn't mean that it doesn't cost more to live. What it does mean is that you wouldn't expect that increase every year. So tariffs are really a tax, not inflation. But they're a tax on the manufacturer and the importer, think Walmart, and the consumer. As best I can tell in reviewing what has transpired, the manufacturer and the importer, at least initially, have soaked up much of those tariffs because they didn't know how big they were ultimately going to be, and they didn't know how long they were going to persist. And the thought was, let's not push all of this off to the consumer if these are truly going to be temporary. I think what we're going through right now is the manufacturer and the importer are saying, doesn't look like these things are particularly temporary. The importer, the Walmarts of the world, are saying, well, I still have to produce profits, or otherwise the market is going to punish my stock value, and we don't want that. So it looks like more and more of the tariff tax is being passed through and is going to be passed through to the consumer as time goes on. That won't necessarily be bad for the market because corporate profits should get on a firmer footing. They're continuing to grow. I just this morning, I heard an interview from a Bank of America person. They have millions and millions of customer accounts that they work with through bank accounts and through credit cards and et cetera. And the takeaway that I got from that interview was that middle income consumers have recently started to pull back. So the cost of everything has been going up, and that really hurt lower income people for the first 4, 5, 6 months after the tariffs were announced. But now it's starting to hit middle income. And since we are a heavily consumer-driven economy, that probably it almost certainly has to have implications for the markets in 2026 as maybe we become way more discretionary about our discretionary spending. So that story, the inflation story, I think is one that persists from now until we don't really know how long. We have 38 trillion of debt, and that is and growing by a couple of trillion every year, and these are in good times. So that doesn't show any signs of slowing down, and that's a weight on our capital markets. The disinflation that we got in the 2000s and the 2010s from things like, furniture and electronics and clothing and car parts that were manufactured largely in China, but other places. Now that disinflation is turning into inflation because the outsourcing has stopped for whatever reason, some of which are good. But if we're going to onshore a lot of that stuff, well, it just costs more to produce things in America. So inflation is something that the Fed is finding very difficult to tame. We're very likely to have it persist for the next year, 2, 3, 5, or more. And I think eventually that has to have the impact of slowing our economy down, which eventually won't be good for our stock market. Right now, there's really no evidence that I can see of all the different indicators I look at that our stock market is in particular trouble. And so what you try not to do in my business, or if you're a super duper do-it-yourselfer with your own investments, is you try not to call the market based on gut feel. When I say call, I mean anytime you want to raise additional cash, take risk off the table, you try to do that not with your gut, but with evidence that you can actually see. And right now, I can't see much evidence of that. So this is not financial advice for you, listener, but we are pretty steady going into 2026, waiting for evidence that things are going to turn.
Great breakdown of all those things, David. I want to give folks a chance to absorb that because those were certainly two biggies, the initial tariffs and their fallout, the inflation closely tied to all of that. If it raises any questions about how your portfolio performed this year, how your financial plan was executed, or lack of execution perhaps of a plan, don't forget that, end of the year, turning the page to the new year, good time to get on the calendar, come in, meet with David, and talk about your particular situation and your plan ahead. You can get a review of your financial plan by calling. The number is 913-317-1414 or going online to creativeoneadvisorsgroup.com. We've got all of that linked and more contact info in the description of today's show if you want to touch base about any questions you have about what happened in 2025, what's coming up in 2026, and of course, the long-term view of how do I retire successfully. You can ask all the questions that are on your mind during that review process. All right, so we're through 2 of our 5 big events from 2025, David, that impacted retirements and financial plans. Let's take a break from those big, heavy ones, and then we'll come back to a heavy one after that. But the next one on the list, this is our breather. High-yield savings accounts, they stayed pretty strong in 2025. Not necessarily a major headline, but kind of interesting to see that was still kind of a positive thing from this year, right?
It was. And actually thinking back over the last decade and a half, this really was a big event because it used to be that your savings earned you zero. In a zero rate environment, you didn't earn anything on your savings and precious little on your CDs or other types of bank type products. So the Fed has been now cutting rates a couple of times this year, and the expectation is that they're going to cut more next year. And so that will, of course, be bad for high-yield savings accounts. And with a new Fed chair, so Jay Powell is very likely to retire in May, and Mr. Trump is going to put somebody in who he has vowed is going to be a rate cutter. Every time the Fed cuts rates, let's say by 0.25%, your high-yield savings account yield goes down by 0.25%. And so we can expect that those yields are going to be lower next year than they are right now. They're lower right now than they were 6 months ago by about a full percentage point. So I looked at a couple of, before we got on the podcast today, I looked at a couple of readily available bank and credit union interest rates. And what you find is that we now have a negatively sloping yield curve for savings rates. And what I mean by that is a positively sloping yield curve would mean that the longer you go out, the more interest rate you get, the higher interest rate you get. But right now, it's actually a negative sloping. So for instance, the rate you get on an overnight high yield savings account, let's just call it 3.75%, is equal to, at the credit union that I happen to do most of my banking with in Kansas City, the 7-month CD rate is also 3.75%. You go out to 1 year, it's 3.6%. 2 years is 3.5%. 5 years CD is 3.5%. So the yield is lower the longer you get out. Why is that? Well, obviously, because this credit union and the bank, I looked at Capital One online banking, their rates do the same thing. And so what they are confident of is that the short-term rate is going to be lower than it is right now. They don't need to offer higher long-term rates to attract your money. The question that we have to ask ourselves is, would we be smart taking the longer fixed-term rate at a lower rate than we can get overnight right now? Or instead of taking that 7-month rate, maybe I take the 2-year rate and lock in the little bit lower rate for longer. I think that's where a laddering strategy for savings makes a ton of sense. Let's say that you have, for round numbers, $100,000 in saving. Maybe you have $25,000 of that in this high yield savings account. But then maybe you look at laddering some CDs for that other $75,000. Maybe you do a 7-month and a 1-year and a 2-year and a 3-year and a 5-year, such that you're taking some of that money and putting it out longer term, such that as short rates do come down, you still have money locked in at the higher rate of interest.
I really appreciate the breakdown, David. And again, that's one that I feel like is not maybe big news to the everyday person, but you as an advisor certainly see that as one of your top items of the year, and bringing that to our attention today. Very helpful. All right, let's get back to the one that did make big headlines. The one that had the name that confused us all, the Big Beautiful Bill, the Big Bill, the One Big Beautiful Bill, the One Big Beautiful Bill Act, the OBBBBBBBA. It had a lot of names, especially for those of us who are in the industry or involved in the industry. It was a lot of back and forth over what exactly are we supposed to call this, the official name, and what's the shorthand. But throwing all that out the window, big tax changes as well as, I guess, non-changes being just as big news here over the last couple of months here from the One Big Beautiful Bill.
Yeah, I think the biggest thing was that we just got the uncertainty of whether or not the 2017 tax cuts were going to expire, and they didn't. They got renewed. And so that was a real big positive thing. So we have some more certainty. There were a couple of things for my retired clients that were big in this, and 65 and over, I guess is what I really mean to say. One is that increase in the standard deduction. So for clients who don't itemize, and the tax law previous tried to make it so that most people don't itemize, but they take the standard deduction. So as long as your income as a married couple is under, and none of this is financial advice for you, talk to your actual CPA or whoever helps you with your taxes for specific advice. But for most retired people, they are going to get an extra, if they are married filing joint, they're going to get an extra $12,000 of deduction on top of the $31,000 they were already going to get for the standard deduction. So add that with the deduction the extra deduction you get when you're 65 and over. They are going to get a little over $46,000 of standard deduction for the next 4 years. That expires in 2028. That was one of the biggest impacts coming out of this bill for my retired clients. If you're single, you get, instead of the extra $12,000, you get an extra $6,000. So your max standard deduction is almost $24,000 this year. So up significantly from prior years. That expires in 2028. What do you do about that? So one more thing. The state and local tax deduction, the write-off that you get, has been capped at $10,000. That would be for the taxes you pay on your home, on your state and local income tax, anything that you pay to a state or a municipality for taxes used to be capped at $10,000, and that's for people who do itemize, who don't take the standard deduction. That's going up to $40,000 this year, subject to, for instance, if you're married filing joint, that starts to get eliminated at over $500,000 is at what point that starts getting reduced. So for a lot of middle income and higher income people, that is a big benefit to the one big, beautiful bill. The one thing that makes me cautious about making decisions about tax law is the question of whether these changes that we had this year are permanent or temporary, which kind of hinges on, well, what's going to happen next year in the midterms? Who's going to be in power? Do we still have will we ever have a 60-seat majority in the Senate so that these tax changes, let's say that instead of a right-leaning Congress, 3.5 years from now, we have a Democrat in the White House and a left-leaning Congress. Then what happens to these changes? At that point, we're running instead of a $38 trillion deficit, maybe a $42 or $45 trillion deficit. And so making long-term decisions on tax law has tended to not be a great idea, but there are things you can do short-term while we have certainty. So, one thing we always want to look at are Roth conversions. Is there a way, based on your income and the tax laws we know about today, is there a reason to be making, they don't even have to be big Roth conversions, but if you do $10 or $20 or $40,000 of Roth conversion with this extra standard deduction that you have, or maybe the extra deduction you're going to get from the lifting of the SALT cap, that state and local tax cap, are those things that you should be doing in 25 and 26 and 27 while we have these in place that you wouldn't have otherwise done because it might have thrown you into a higher tax bracket? So I have a number of clients that would kind of like to, retired clients who would kind of like to stay in the 12% bracket. And for married filing jointly, that ends at a taxable income about $96,000. I have others that say, well, I'd really like to stay in the 22% bracket. Well, that gives them headroom up to $206,000 of taxable income. That's also about where the IRMA, the penalty that you pay in higher Medicare taxes, kicks in at about the top of the 22% bracket. So there are a number of different things that you want to be aware of as you are thinking about things like Roth conversions. But the big beautiful bill gave you some extra room to think about those things in 2025, 26, 27, and 28. So no real need to make a rush decision in 25. But if you don't have time to think about it in 2025, at least make a determined calculation as to whether or not 2026 would be an opportunity for you to maybe make a Roth conversion, get more money out of the way of the IRS for future years, reduce the amount of required distributions you might have to take after age 73, and take advantage of the tax laws that we know about today, since, frankly, everything with tax law ends up being temporary.
Yeah, that was the funny part, right? These are permanent changes for a couple of years.
Exactly.
Temporarily permanent, however you want to phrase it. I love it.
You know what? One thing I did look up, I asked myself the question this morning as I was thinking through our remarks. When's the last time that we did have a 60-seat majority in the Senate, or a filibuster-proof majority? That was actually less time ago than I thought. That was 2009, 10, and 11. And so right now, the last decade or so has been marked with really, really super slim majorities in the House and the Senate. It's unlikely that that's always going to be the case going forward. At some point, we are going to have a 60-seat majority, and it depends on whether that's a right-leaning majority or a left-leaning majority. One set of politicians may decide to just end that filibuster rules, which requires a 60-seat majority. So there's a lot that can happen depending on who's in power with these types of tax laws and changes. So I just encourage all of us, including me, to think about, let's consider real carefully the changes that we make based on our long-term thoughts about where tax rates are going, and just try to do the best we can with the information and the definitive rules we have in hand.
Very good stuff, David. All right, we go to our final one here, and this is the most recent, I guess, of all of these that happened near the end of the year. We're hoping no other major news comes out in like the final week of the year after we release this episode, right, David? Or else I guess we'll have our first topic for 2026 taken care of for us.
Yeah, and let's not hope for that.
Yeah, exactly. Let's have a nice quiet Christmas, New Year's, and then we can, start 2026 off with a bang if we need to. But let's look at the record-breaking 43-day shutdown. Again, I feel like this is basically the news every year. There's always shutdown talks, but this one went on a while and had maybe some bigger ramifications than the average shutdown, if you will.
Well, it did for a certain subset of Americans. For the vast majority of us, it was an interesting news article. We didn't lose any money. We didn't gain any money. The market didn't care because they knew eventually it was going to get fixed. There were some short-term impacts. Almost 1.5 million federal workers went without pay for 6 or 8 weeks. A lot of air traffic controllers were getting kind of bummed out, and some of them didn't show up. So there were some travel disruptions. But really, the economic impact of all that was very modest. And so, frankly, from a financial planning perspective, what it really made me think about was how many of those people that were affected actually had a good emergency fund set up so that they could pay their mortgage, their car payment, buy groceries, pay their heating bill. So maybe the next time one of these types of things comes around and it does affect you instead of just federal workers, the question you're going to ask yourself is, do I have a good amount of emergency funds set aside? And if you don't, or if you don't have easy access to emergency fund money that is not subject to the ups and downs of the stock market, what's a good time? When's a good time to make sure that you do have that? Well, right now, when you don't need the money, but to make sure that you do have the access you need to maybe, in our business, we always trot out the phrase 6 months of living expenses. But if you don't have access, if you don't know where you would go tomorrow to have easy, non-market access to 6 months of living expenses, I would strongly encourage you to figure that out today, tomorrow, or next week. But I wouldn't wait till a month or two from now. Especially if you're in your 30s or 40s or 50s, when you become pretty reliant on your paycheck, and maybe you are slamming away a lot of money into 401ks and not very much into brokerage accounts. And the 401ks, of course, have taxes and penalties when you want to go get the money. So just go through that exercise sometime in the next day, week, or month to make sure that you do have access to 6 months of living expenses. And you're not going to expend a bunch of energy and sweat if something like that does happen to you.
Really great breakdown, David, and absolutely a lesson that we can all learn, even if we weren't affected by it directly in 2025. The federal workers certainly went through it, and that could happen to any of us. Doesn't have to be a government shutdown, right? But any type of instability, whether you're self-employed or working for a large employer, not to be fearful, right? But you're never safe completely, so get that emergency fund in place, and it's going to help during those ups and downs and turbulent times that we may face in the future. And if you're retired, it's really the same concept. Make sure you've got that emergency fund, that ability to cover those expenses. It's so important and an essential part of any financial or retirement plan. Well, we had a lot of noise in 2025, David, but hopefully folks adapted well, and we'll be looking forward to what 2026 has in store for us as well. Hopefully less drama, but if there is, we'll be here to talk about it, right?
Yeah, absolutely. And every year has drama. And a lot of it just comes right out of the weeds, totally unexpected, but it creates a lot of stir at the time. So we don't know what 26 is going to be. We didn't know COVID was going to happen in 2020 or whenever that was, and that persisted for a while. It just came out of nowhere. Something will come out of nowhere in 2026 or 27. I think the takeaway for me, based on what I do for a living, is when I look at these 5 things that we discussed, none of them really had an impact on my clients' plan. They might have provided some opportunity to do silly things with your money, opportunity to do smart things with your money, but none of them really impacted the plan. So as these things crop up in 26 or 27 or whenever, as they will, and some of them are going to be bigger than others, but it's always really, really important to just be able to go back to your plan and say, okay, how did what just happened? I know it might have had a temporary impact on my portfolio, but how did it impact my plan? If you're not able to do that, what that probably means is you don't have a plan. And in your 20s and 30s, you ought to have a plan that is maybe Excel-based or maybe just a yellow work pad. But if you're in your 50s or 60s or 70s, you have to have, even if you've done exceptionally well for yourself over the years, you need to have a plan. And hopefully it's written. And that's what you go back to in times of stress to say, okay, with all that going on in the background, did it impact my plan? And if it didn't, then stay the course. That is not financial advice for you.
Good to clarify at the end there, obviously. But yeah, really good takeaways today. And get that plan in place, and hopefully it eliminates a lot of the worry when we have these ups and downs. If you don't have a great financial plan in place and you'd like to get one and you'd like a review of where you stand right now, again, I'll just reiterate, you can go to the website, creativeoneadvisorsgroup.com, or call 913-317-1414. Contact info also listed in the description of today's show if you want to find it there. Don't hesitate to get in touch and get a financial plan in place. David, thank you for a great 2025. Looking forward to 2026 with you coming up in a couple of days. Our next episode will be into the new year.
Happy New Year to you and all of our listeners, and let's just make it a great 2026.
Sounds great. Merry Christmas. Enjoy the holidays, everyone. We'll see you soon right back here on Cover Your Assets, KC.
Creative One Advisors Group has been proudly serving families in the Kansas City metropolitan area since 2003. Over the years, we've evolved to help meet the needs of our clients, becoming KC Financial Advisors in 2010. In November 2021, our advisory business was acquired by Creative One Wealth LLC, C1W, and in January 2025, we officially adopted the name Creative One Advisors Group. Previous episodes were recorded under the branding of KC Financial Advisors, which has since been rebranded as Creative One Advisors Group. Any references to KC Financial Advisors should now be understood as referring to Creative One Advisors Group. Investment advisory services are offered through Creative One Wealth LLC, a registered investment advisor. Creative One Advisors Group is a DBA of Creative One Wealth. Insurance services are offered through licensed insurance professionals. Investment advisory services are provided in accordance with the fiduciary duty of care and loyalty that includes putting your interest first and disclosing conflicts. Insurance services have a best interest standard, which requires recommendations to be in your best interest. Creative One Wealth is not affiliated with or endorsed by any government agency and does not provide tax, legal, or estate planning advice or services. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss. Neither asset allocation nor diversification can ensure a profit or guarantee against losses. None of the information contained herein shall constitute an offer to sell or solicit any offer to buy a security or any insurance product. Insurance product guarantees are backed by the financial strength and claims paying ability of the issuing company. The Creative One family of companies includes Creative One Wealth LLC, a registered investment advisor, Creative One Securities LLC, member FINRA SIPC, and a registered investment advisor, and Creative One Marketing LLC. These companies share common ownership. Additional details regarding advisory services are available in our firm's ADV Part 2A and Form CRS.